Welcome back. We're going to continue looking at the profitability ratios, which we already started by looking at the return on owner's equity. There's two more ratios we need to pay attention to. It's the gross profit ratio and the net profit ratio. This tutorial will focus on the gross profit ratio specifically. Okay, so the formula for a gross profit ratio is we're looking at the gross profit, obviously, and we're dividing it by the sales revenue. We express the answer as a percentage, like almost all of the other ratios. What this ratio is showing is it's showing how much profit we're getting back, or how much gross profit we're getting back for every sale. Essentially, what it's showing is how much is being left over in our profit once we subtract the cost of goods sold. Once we subtract the cost, the expense imposed on us to purchase the good, hold it, and then sell it on. That is what the gross profit ratio is telling us. How expensive really are our costs of goods sold. So we run an example very quickly, $234,000. We're going to divide that by $346,000. So the gross profit divided by the sales revenue, that equals 0.676, which is 67.6%. Okay, very quickly running back through this, you know this, to answer a ratios question, you need to calculate the ratio. You need to make a comparison. Is the number you've got healthy or sick? And lastly, you need to recommend something. What action should the business take based on these numbers? Okay, so the real issue with this ratio is it's basically, we're going to compare across the years. How have we done from year 1 through to year 2, potentially into year 3? If there's a fall in the gross profit ratio, that's a problem. But if it's staying stable, that's okay. And if there's a rise, then we're in a good position. That's what it needs to show. It just needs to be stable or getting better. To deal with it, if we're having a problem, if our ratio is decreasing, we need to really look at how much we're paying for the goods that we're selling. We're trying to reduce that cost of goods sold. So either we're purchasing too much stock during the year and we need to get rid of that because we've got too much closing stock, or our supplier has become too expensive and we need to find another supplier. This is nice and easy because we just need to look on the revenue statement. So let's do this. Please note that we're looking in 2014, 2015. We're going to calculate both because it's a comparison to see if we're doing better. Okay, so the first thing we do is we look at our gross profit, which is up here. So that was our operating income, our sales, or our revenue. That goes by different names, you should know. And we have subtracted from that our cost of goods sold, and that will give us our gross profit. Okay, so our gross profit divided by our sales, and that equals 0.707, which is 70.7%. Let's come across to 2015. Let's see how we're doing over the time. Our gross profit is 154,000, and we're dividing that by our sales revenue, which equals 0.70. Okay, so is the business in a good position or not? Make the comparison. Clearly, it's holding steady and constant across the years. It's not a bad position for the business to be in. So here we've got across the 2 years, 14 and 15, the business maintained a good gross profit ratio. For this reason, there is no need for the business to change its current strategy. All right, you're going to try it now yourself. I'll get you to press pause. Run the calculations, please. All right, let's have a look. 2014, our gross profit, 2014, $241,300. Our sales revenue, our income, was $329,000. That equals 7.73 or 73.3%. Let's come across to 2015. Our gross profit is $326,700, and our operating income was our revenue was $389,000. Okay, 83. All right, we have an improvement in our situation here. So across the 2 years, there's been an improvement. This is due to improved sales, and no immediate action needs to be taken. Okay, so we've had one business that stayed constant. We've had one business that actually had an improvement. Let's see what happens in our third one, Holmes Hammers. 2014. Oh, press pause. Run the calculation. Okay, 2014, we had 228,200 gross profit. We divide that by our sales. That equals 0.647. Let's go over 2015, 47,700. We divide that by the 220,000 sales equals 21. Okay, what's happened here? Clearly, we have a diminishing of our situation, and here we have an issue. The business has seen a decrease in its gross profit ratio. The business should take action to increase sales and reduce the cost of goods sold in order to improve this situation. Very straightforward. If you like the channel, please subscribe. Please leave a comment. Tell me you hate it. Tell me I calculated something wrong. Tell me you don't like my hat. Or if you want to, thumb the video up or down. Thank you very much.